Hi, my name is Amit Kumar Jain and I am the fund manager for the Samsung India Equity Fund. The fund aims to achieve long-term capital growth by investing in companies that have their business primarily in India. It seeks to construct the portfolio bottom-up, focusing on good quality stocks. India is currently in the midst of a second wave of COVID infections. The number of cases have risen sharply from 20,000 to almost 250,000 a day, resulting in localized lockdowns and fall in economic activity. However, at the same time, India is at the forefront of vaccinating its population. It has already administered over 130 million doses by 20th April. From 1st May, it plans to open up vaccination for all adults over the age of 18 and is taking concrete steps to boost production of various vaccines. India should be able to vaccinate a large part of its population by the end of the year and, more importantly, be better prepared when it comes to booster shots for variants next year. India has clearly shown its interest to becoming a manufacturing destination by launching various schemes that aim to reduce import dependence, ease regulations relating to land, labor, taxes, and promote manufacturing. India aims to garner a fair share in the global move to diversify production away from China. India, like rest of the world, has ensured ample liquidity in the system, which has resulted in lower interest rates. Together, the pent-up demand arising from COVID lockdowns, higher wealth and savings with the rich and middle class, and government incentives has led to increase in consumption of discretionary items like autos, real estate, white goods, and kitchen appliances. We expect this trend to continue over the next 2 quarters. Unorganized players will continue to lose market share to the more organized players, a process which started with demonetization and GST, a uniform sales tax rate that made evasion of tax difficult, and has accelerated under COVID as smaller players have not been able to manage the supply chain disruptions with as much agility as the larger organized ones. The organized corporations are typically the listed players. We expect markets to grind higher as earnings rebound will be strong despite expensive valuations. The difference between now and end 2019 is that now global liquidity is higher and we are at the beginning of a multi-year strong GDP and earnings growth. The only reason why we don't expect a runaway bull market is that valuations are full on an absolute basis, trading at almost 2 standard deviation above long-term average. The fund follows a QGV framework, that's quality, growth, value, to select stocks. Of the 3 vectors, growth is most important, followed by quality and lastly valuation. The fund owns names that are a mix of what we call compounders and turnarounds. Compounders are stocks that tend to grow earnings within a defined range over time. Price growth pretty much follows earnings growth. The turnarounds are stocks that enter the portfolio driven by change, be it economic cycle, business dynamics, or management, or even regulations. The key is clear, identifiable, and time-based catalysts that have or will lead to the change. The portfolio typically has 30 to 40 names with a blend of large, mid, and small caps. We are overweight chemicals and industrial names as a proxy to manufacturing. We continue to remain neutral on financials. However, within financials, we are underweight lenders and overweight insurers. We are also overweight real estate after a long time, as we believe there is a reasonable chance that we are at the beginning of a real estate upcycle. We have funded this by maintaining a large underweight on consumer names driven by expensive valuation and tepid growth in the medium term. Thank you.